The people that save actually make them the most money, but because of volume, the people that are negative or in the debt side are also making the money because there's too many of them and there's not enough financial education, which is why I've made a channel like this to try and maybe enlighten some people who want to be enlightened. Because let's be honest, nobody wants to watch a finance video, but here you are watching a finance video, which means you're smarter than the majority of the people. You are not the majority, okay? So that's off to a great start. You're realizing that finance is a game. And what they're usually going to do is when you're applying for a credit card, right, you're going to have to meet the affordability criteria because they want to know if you can actually afford the product. But what they actually want to know is how much are they going to be making off of you? Hey. Welcome back to the channel. So today I thought I should do something differently. Just, talk. I don't know how that is different really, but I just wanted to make a video that's simple and speaks to the people, right? So as you've seen, most of my previous videos are about credit cards and whatnots. I wanted to make a video that talks about the banks in South Africa and my thoughts on it. And I'm pretty sure some of y'all know where I'm going with this. So banks can be favorable. Banks can help you build wealth. And oftentimes this can work out great in the way that you want it to work out. But in most cases, it doesn't. But either way, the bank comes up at the top. Banks essentially make profit one of two ways, right? So you're either on the positive side or the negative side. Are you the people that come up at the top with the bank, or are you the people that are being suppressed by the banks? On the positive side, you're going to be a person who saves a lot, right? You're either a person who just uses a bank to take your money and save it, or you're the kind of person that leverages their products, uses those on a day-to-day basis. The difference being that usually the people that have the most benefit from banks are the ones that save a lot more money. And then there's people that use products. Most of us are in this category. This is where you don't have strong savings. You essentially, need a product that'll work with your lifestyle. Whether you're looking for discounts or low fees, like Capitec is offering R7.50 for a product, a banking product, but essentially on everything that you swipe on, you pay for. So this may work for you the best, but it's not always the case that it's going to work in your favor. Some days this is going to suck where like you have a lot of money in your account and then they take a huge cut out of that account. So yeah. Banking is the best when it comes to the people who use it for saving. Let me explain what a bank is first before I get into anything. A bank is a risk management business. So they protect your money from losing its value when you're saving it. So they're designed to literally take the least challenging path to money making. All they're built to do is make more money, right? And the way that they do it is hedging risks and ensuring growth of funds. So what they do is try to mitigate as much of a loss as they can. Like they are running far away from losing money, from carrying debt and stuff like that. And so essentially their systems are tailored to making things a lot more easier for them and no one else, I kid you not. So banks are essential. And because they know that we need them, they're going to continue being pretty much terrible for the rest of us. But at the same time, if you don't bank with any bank, you're kind of losing money. And let me show you why. Inflation, right? Inflation is one thing that the bank hedges against. Inflation is essentially losing your buying power after a certain number of years. And you lose money because everything is becoming more expensive. The trade prices are different and the government regulates all of that stuff. The Reserve Bank is in charge of doing that. And yeah, that's essentially what inflation is all about, right? Banks are just the middleman. Banks are just the people that are in between the government and, the regulation. Let's say the Reserve Bank. In this portion of the video, when we're talking about the government, will refer to them as the Reserve Bank. Okay, so when I'm saying Reserve Bank, you'll know that I'm talking about the government. Yes, the Reserve Bank, which doles out the standards of how the banking is supposed to happen and stuff, that's their job. And the banks are essentially the people that help people like you and me, as well as businesses, not lose value from their buying power, so that we are able to trade equally. So I don't want to contradict myself. You can just do your research on basic economics and how it works. Essentially, everything is pegged to the dollar right now, and that's what they're trading against or something like that. But yeah, just do your research and, let us know what you think the economy works like. But yeah, banks help or benefit people that have a lot of money. So if you're a millionaire, if you're just coming up to being a millionaire, if you have the double digits in your account, like you're 100,000 near, if there's such a word, or you're like, you know, a person earning billions or whatever. A person earning billions probably has their own level of banking and how they move money around. Yeah, it's different for them. But essentially, for the rest of us normies, people who save up, let's say you're saving up like 10,000 rands a month, banks target people that have a lot of money or are planning on saving up for a long term. So the only way that you are going to be making money through a bank is if you know, have a savings account or an investment portfolio or something like that. Any other way is not a guaranteed way, and you're probably losing money than gaining it. I will get into that on the other side of the negative spectrum. So the only known way that you can attain wealth right now is through savings, asset holding. There's a bunch of other things, but mainly it's these two things. Or running a business, of course. If you are a person who's saving up amounts of money, like copious amounts of money in the bank, what essentially a bank is doing is they will offer you an interest rate. They'll say, hey, we are offering you 8% on your savings if you save up for maybe 5 years with us. But annually, you'll be earning 8%, right? And then we'll be using the power of compound interest to grow your money. And you're like, oh, sweet, that's really nice. I'm super excited. And you start saving with them. You start saving with the bank, right? How they make the money grow or how they get money is they'll take all of that money, put it in their global account with their trade partners, with their shareholders, with the, you know, the actual people who trade stocks and exchange money, and they do whatever it is that they do there. They take all of that money. Let's say maybe you invest 100,000 rands, right? You take all of that 100,000 rands and they put it somewhere else. It's not in your account anymore. What is actually in your account is just a number that says, hey, you're holding 100K with us, so don't forget. And you're going to be earning 8% at the end of the year. Now, is 8% a really good interest rate? Sure, if you're getting 8% accounted for inflation rates. Here's the thing. If you're saving up monthly, right, and maybe by the end of the year you get to 100K of savings, all of that money, they take it, they invest it, right, somewhere else. And if you decide for whatever reason to withdraw early, a portion of your money, for example, they're going to charge you. The reason why they're charging you is because they have to now go through the hassle of tapping into their reserves or going to fetch someone else's money to borrow you. Essentially, you're paying to borrow money because where's your money? It's not in your account. It's somewhere out there, fluctuating and moving around, right? So that's what they do. So while it's fluctuating out there, they've offered you this 8% product and they're like, yes, you will earn 8% by the end of the year. And over 5 years, this will be even more. And you're like, awesome. So they've kept it at about 8%, and they've adjusted all of the regulatory things there by, the Reserve Bank, according to the Reserve Bank standard, of course. So they've created this product for you to save money with them, but they invested somewhere else that's not inside banks. They invested on the money markets, on the stocks, on the share prices, all of that stuff, and they are guaranteed to earning maybe something around 15% of a return on your money, for example. And they get 15% of that money, and they give you only a portion of this every month. And then they take all of those earnings of the interest and reinvest them again. And they keep on giving you little bits of portions of money, but it's actually growing exponentially more on their side, right? Still compounding rules, but you're on their product, you're capped to that 8%, but they are not. They're earning a lot more or a lot less sometimes. So it's really risky, but they are the people that are willing to hedge that risk. They're people that are willing to deal with predicting the markets and how things will work. Let's say you reach that 5-year end contract. You would have gained interest.
We're assuming it's a fixed deposit, thank you.
That interest comes back to you as 8% by the end of the year, which means you're earning minimally less on every single month that you're investing. But yeah, after 5 years, they release back your money into your account because they know you might have the potential of claiming it back or something like that. I don't really know how they do it, but this is a hypothetical. But yes, by the end of your term of investing or banking with them, they're essentially saying, hey, here's your money back, plus some, because we're a generous bank. But what they don't actually tell you is that they adjusted for inflation at the time. So your money, because you notice that every single year they adjust the interest rates on your account, it's because they're regulating it so they don't lose money, right? When the Reserve Bank tells them, nah, you guys gotta drop the rates and stuff, they'll adjust their inflation points. So if inflation is down, essentially their interest rates will go down as well. Because, if they kept it at the same rate, they'd actually be losing a lot more money, if that makes sense. I hope I said it in the right way, but if I didn't, I'll probably write it down, because sometimes, you can get camera shy and the things you meant to say don't come out as you thought they would. Continuing on, after that fixed term of yours, you get your 100K plus maybe that 8% earning. Your 100K, when you're initially investing it, is worth 100K, right? But because of inflation, your buying power becomes less. What they do is account for that difference. So they account for your buying power plus the amount that you have made over interest periods. And they try and put you just above inflation rates. So maybe if the inflation is 3%, they make sure that over the 5-year period, you have earned just the right amount. Like it might be 160,000 rands after the 5-year term, right? When you're looking at the numbers, it's 160,000 rands, but its buying power is worth 100,000 rands. Does that make sense? So what the bank does is cleverly give you like a 2% or just a 1% above inflation rates so that you see that you actually did earn money with them. But what they don't tell you is while they were trading your money, they were getting a lot more than that, right? And they probably accounted that they're going to get a lot more than that. But they give you just a tiny portion. Okay, I hope so far I've been making sense. So essentially, that's what the bank will do. They will give you just above the inflation rate and just a tiny portion of it, which means the interest that you actually truly got is a lot less than what you think it is. It's not 8%. When you earn your interest after that 5-year period, right, you earn your interest back, you'll usually find that it's split into two. The half of the percent, or like 70% of it, is accounted for inflation rates. And then just a tiny bit is actually your earnings. So just be aware of those things, okay? But the bank made more because they had a lot more value on their hands. And they had to give you just a tiny portion of that money back so that they could keep the rest. Now, with all the money that they made from your savings account, they're going to take that and save some of it. Some of it they distribute it and loan to other, financial service providers like loan shark schemes, traders, whatever it is, other banks, whatever it is, they're going to take some of that money left over. And then some of it obviously goes to operations. And then the final amount, which takes us to our next segment, is going to be the negative. Some of that money that is left over is going to what? Products. So essentially what the bank will be offering as a bank. Usually they'll provide or create some sort of retail product. That amount of money is allocated for products. So what are products? Oh, it could be quite a number of things. Insurance, it could be like SIM cards. I've seen a lot of banks are doing that now, but essentially most of it goes to your debit and credit cards. So that's where they make their earnings as well. So those products are from the people who saved. I apologize for my lighting. I'm just using natural light today. Like I said, I wanted the aspect of this video to be a little different. Moving on, banks will use that invested money to do cost of business, operations and stuff like that, which is why we give our money to them to save, because you don't risk your money. You know that it's safe because a bank is holding it. And there's going to be a cost of holding some money and stuff like that. And what they do is they modulate it so that when they're charging, they always come up at the top or profit. But yeah, that's how every business works. Shocker. So the difference being that the money that they made from the savings is product allocation, creating credit cards and debit cards. So again, credit cards are regulated by the Reserve Bank again. And they get to put a cap or a limit on how much a bank can actually make. And a bank has to play around what they offer and stuff like that. And so they offer less if the Reserve Bank is capping them too much, typically. They take some of the money that is left over and they create a product like a credit card with some cool reward incentives to invite you in. You're essentially losing money with a credit card because they are always hoping that you will spend using their product, you will pay a monthly fee on that product, which is slightly more than some debit cards. Credit cards are a lot more, expensive. And what they're usually going to do is when you're applying for a credit card, right, you're going to have to meet the affordability criteria because they want to know if you can actually afford the product. But what they actually want to know is how much are they going to be making off of you when you do make a mistake with that credit card, which you will eventually. It's inevitable. So they try to entice you to spend more, to use more money because they know eventually go to a point where you're above your limit or above your means. And that's where they get you, right? These interest-free periods, they just are part of a psychological working thing. Again, this is not financial advice. If you sue me, you will not win because I told you this is not financial advice. But essentially, yes, they make profit off of people who don't pay the credit cards back, people who are none the wiser on how credit cards work, and they will pay the minimum, not realizing that they're going to incur fees. And even if they do, sometimes they know, it's negligible. I'm just gonna, pay off the credit card once I'm done with this thing that I want to achieve. The credit card gives me more power. The bank is like, sure, we're cool like that. We'll offer you our money so that you can succeed. You can make us more money, right? But if you fail, we're not losing anything. We have insurances on the credit card. We know that if something happens, we're protected against that. So therein goes in another facet where they're paying for insurance. So essentially, banks are a big hub that consists of these many little facets that work together. It's a system. So yeah, they make money in those two ways, the positive and the negative. You're either going to be a person who saves, which is why they're encouraging you to save. The people that save actually make them the most money, but because of volume, the people that are negative or in the debt side are also making the money because there's too many of them and there's not enough financial education, which is why I've made a channel like this to try and maybe enlighten some people who want to be enlightened. Because let's be honest, nobody wants to watch a finance video, but here you are watching a finance video, which means you're smarter than the majority of the people. You are not the majority, okay? So that's off to a great start. You're realizing that finance is a game and finance should not be treated as something fun. Finance is essentially boring. You just have to be aware of the things that are happening. Basically, when you're saving or when you have a savings account with a bank, what you're doing is freezing your amount of money. Freeze! So that even after the inflation rates change or fluctuate, your money still has the same amount of buying power. So that's all you're doing with a savings account. It's a freezing tool. So you keep your money the same. Even if the number is different, it's still the same amount of money you made like 5 years ago. But I digress. Essentially, they make the most money from the people with savings account because, if you're earning like 10 or 15 million or whatever kind of millions, and they take those and they invest, obviously the return is more substantial. And if you really think about it, it makes sense. The more they make people wealthier, the better they have in return, right? They can make more profit, more business, more turnover. So they'll have in-house services like a banker or a financial advisor who will tell you, nah, don't spend your money on this. Rather take this route and buy something else so that you can make more money off of that. They know that you'll be using them for, the tailored services. And you'll keep on saving that money so they can use it for something else. So that's the cost of doing business with a bank. So let me know what you thought about this video. Let me know if you have a different opinion from what I'm talking about. If you actually are a financial advisor, please vet this information that I've provided and maybe fix some mistakes, because I'm just talking here. I'm just trying to get people to be more aware on the topic. It's their jurisdiction to then do the research and hold themselves accountable to the information that they take in. So yeah, if you're a person who's a lot more informed, please let us know, confirm what I've said is true. If it's not, please let me know. I would really appreciate any input that you share with us. Which bank do you bank with? And are you the credit side or are you the savings side? Or are you both? Because actually, believe it or not, credit can be a powerful tool if you use it the correct way. But a savings is substantial. You need a savings account, please. Make a savings account. Even if you don't think it's substantial, it can help. Freezing that money in position can oftentimes give you the best benefits than not having a freezing account. But yeah, I would like to thank you for watching this video till the end. You're such a legend. You're a star. I hope to be seeing you in the next video. Peace.